let's start the session recording again. Yeah, Jonathan, are you back? Can everybody hear me? Probably gross income, yes. Okay, so we just talked about the first two income approaches. And if we're finance people, can we ever stop talking about this kind of present value, right? we always have one thing to fall back onto, that is to discounted cash flow, right? So compute the present value of future cash flows. First of all, forecast NOI, then choose the holding period. So instead of assuming that NOI is going to be held forever, now we are going to choose a holding period. Select discount rate based on risk and return or comparable investments and determine reversion value of the property. So assuming towards the end of it, we are going to sell it. Okay, so what's the difference between the net operating income approach that we previously known? Previously, we assumed that it's going to be an infinite stream of net operating incomes all the way towards the eternity, let's say, whatever that means. And then we are going to choose the discount rate based on risk and return of comparables investment, that's a cap rate, but we are not going to have this reversion value. Does that make sense? So we're not going to consider the selling of it towards the end. So here we are going to consider that towards the end of the investment, we are going to sell this this property for the reversion value. So suppose, let's look at this hypothetical Hills apartment. Net operating income is given year 1, 2, 3, 4, 5. What do you think about it? Looks pretty good, right? So the net operating income is growing a little bit every year, and for 6, 7, 9, 8, 9, 10, then it is growing less and less and less. So although it is still growing, but looks like the trend is not good. Okay, so how are you going to calculate it? Well, method number one, okay, so how are you going to calculate the reversion value? Method number one, you discount remaining cash flow using a terminal cap rate. So same story, because now if you're looking at the selling point at the reversion time at that point, looking into the future, if we draw a I here and I in here, looking at that time into the future, then it will again become an infinite stream of income. So we can again going to choose a cap rate, but this time, because it's not a cap rate right now, it is the cap rate at the terminal time, so we're going to call it a terminal cap rate. So the terminal cap rate should really be equal to the average long run growth, the return discount rate minus the average long run growth. Okay, so when it's totally discount rate R, then the growth is 0. If the growth rate is negative, then the two of it will be added together, and so on and so forth. So if you are familiar, if you look at this one, does it look familiar to you? Anybody? Have you seen it before? Have you seen similar dividend discount model, exactly. Yeah, DDM, Golden Growth Model. Okay. Right, so basically most of you recognize it looks really close to what we have in the old time days, financial management. The price today, or 0, should be equal to the next period dividend divided by the growth, the discount rate minus growth, right? So if the growth is negative, then it will be a plus sign here. So still have 6 no response. Are they coming back, or are they not back? Some of you have not been responding at all. I just wonder. Okay, so note that if you're calculating the reversion at the end of year 9, so you use year 10's net operating income to do this. So this is one way, actually not an exact science, but this is one way to calculate the reversion value. Okay, yep, somewhat familiar. Method number 2, estimate RT from sales data. So basically, suppose we have a 5-year holding period for a new property. In general, as property ages, they become less able to produce income relatively to younger peers because people like to stay in younger facilities, apartments, because their features are new, facilities are new. So it will be less attractive over the time. As a result, the cap rate should be higher for older properties. So what is the current cap for a 5-year-old property? So in this case, we are really looking at just looking at the age of the property and take that as a factor. Okay, so and age of the property, on the other hand, is a different concept than when is this property really, when is this property really got sold recently. Does that make sense? So it could be sold 2 years ago and it's a 10-year-old property. It could be sold, say, 10 years ago and it's a 1-year-old property. Does that make sense? So it's a 2 different thing. And depending on how old are they when they're getting sold, we can somehow factor that in over the time. You have a sense, if you process the data enough, you have a sense of how much of the age will come in as a factor of the cap rate. Age determines whether there's a premium or discount on property. Not really. We're looking at the cap rate. Remember, the cap rate is going to be on the denominator. So we're just saying that the cap rate will be higher, a deeper discount for net operating income for an older property. Does that make sense? Kind of, yeah. It's because or the profitability, if you're really looking at net operating income, the profitability is already included. It's just, I guess, older properties have a higher risk looking into the future, and that's why the cap rate tend to be higher. You're not able to say, yeah, so you could be having 2 rental properties that are both giving you steady streams of $3,000 rent, right? So one is 5-year-old and the other is 35 years old. We're not going to price them the same. That makes sense. So you can't just look at the net operating income. You have to look at the age as well, because the longer the age is, just like an older car will likely have more maintenance and repair. The same thing on the property. Okay, so then on top of these 2 methods, method number 1, we use what? More like a discounted not discounted dividend, but discounted net operating income kind of model. The second one is what? estimating the cap rate from the sales data. And the third one now is we want to estimate the resale value from expected change in property value. Okay, so suppose a property has a projected year one NOI of 200,000. 200 grand. Net operating income is projected to grow by 4% per year. What did I do? I just highlight the whole slide I did without noticing it. Okay, so for the following 2 years, okay, then by 2% per year for the subsequent 2 years at a 1% constant rate afterwards. Then given a required rate of 13%, what is the value of the property? Hey, you guys should be able to get this, right? So it sounds awfully similar to some of those financial management project valuation kind of question. So can we figure this out together? So the second year, what is this? The third year, yep, go for it. Okay, so after that, it's all 1%. What's the value of the property? Okay, any thoughts for the second year? $200 times 1 plus 4%, right? So that should be equal to, yeah, this is the part I don't like, and I'm like, yeah, it's kind of harder to get feedback from you guys. Good. Okay. Seems everybody's getting a handle of it. So we're really looking at the whole schedule, right? 4%. Then on top of that, 4%. Right? And then on top of that, 2%, 2%, and 1% thereafter. Okay, so then from that point, can you estimate the ending reversion value? Reversion value. Okay, reversion value should be equal to 225,059 times 1 plus 1%. Don't forget this part because you need the year 6 net NOI on top of that, right? So, and it's what, 13 point something minus 1% growth. Anybody remember the discount rate? 13 point what? Oh, it's just exactly 13%. Okay, good. Yeah, so if you calculate that, that should be equal to 1894 2250. $1.8. What do you mean? All right, so 225,059 times 1 plus 1% should be 227,310. Okay, yeah. Oh, 246. Okay, there's slight rounding error. Okay, so that's the terminal value of 5. Yeah, and then you add this terminal value of year 5 back to the cash flow in year 5. So that's going to be year 1, year 2, all the way. And then you put it in the cash flow. Remember, the first half of semester we talked about how to use the cash flow, right? Cash flow function, the whole thing, in a calculator. You put in these cash flows in there, then put the cap rate equal to 13% and calculate the whole thing, and that is close to 1.8 million, but 177,549. Okay. Have you got it correctly? Good. Okay, let's see. How many of you got it correctly? Yes, raise your hand, not raise your hand, choose your response. Okay, so many of you got it correctly. 4 of you. 6 are not responding. Okay, so now is a good time to introduce the highest and best use. So whenever we're talking about the land, okay, land prices are a lot more volatile because it's determined by its highest and best use. Okay, William, can you share why? You can use your microphone if you can. Because oh, I see. You did not subtract the growth rate from 13%. Well, but if you did not subtract 1% from the 13%, then your cap rate should be too high, and your final value should be lower than the correct value, right? So now your value is too high. Maybe you want to check again. Okay, let's move along. So for the land value, it's a little harder to estimate because it's really, for the same, if it's an office building, then yeah, it's going to be the office building income and everything. If it's a facility, then it's a facility income. But for the land use, you are going to look at all the possible all the possibilities, and that's actually exactly what you're going to do for the term project. I have posted the term project online today. Basically, we have this little motel kind of business owner. They own a piece of adjacent land. Okay, so what you need to do is try to figure out for that piece of land, what's the value of it. Okay, so basically you want to figure out what is the best use of it. And if you are going to be able to figure out the best use of it and do a plan for the land development, and that's your goal of the term project. So I hope it sounds interesting to you. Okay, and that's the essence of the whole thing. And whenever we are looking at the land value, we also have everything having the present value of the whole building minus the building cost, and that should be also the land value. Okay, how do we reconcile these? First of all, it has. You think about this as the demand side and the supply side. So from the supply side, selling this property and say, okay, if I have the present value of all the potential users, okay, the highest potential users, minus the building cost, that should be really equal to my land value right now. And for the demand side, what's really making sense to them is they're going to figure out the present value of whatever usage they're going to use it, right? So step number one in this case is to compute the present value of the estimated cash flow for all the alternative projects that you can build on this piece of land. Being it a parking lot, from a parking lot to recreational park, anything you can think of how to use that land, then you should conclude that and include that as an alternative, as a pool of possible projects in it. And then you pick out the highest one, okay? Well, actually, in this process, it suggests that you are going to subtract the building cost, of course, because building costs are different for each one of them. And then you're going to select the highest value among the alternatives. Okay. So the last approach for evaluating these properties or commercial properties are the cost approach. And the cost approach is apparently easier for the two ends. I usually describe it as for the beginning property, because if that property has just been built, doesn't have a long track record, maybe in operation for first year, second year, then the cost approach will make a lot more sense, because the value of it is not really established through its operation. It's easier to establish the value on top of how much you can build a similar facility or similar kind of apartment using your own money, right, in the same or similar location. So if that value is not equal to exactly or too far away from that cost, then you can say, hey, why don't I just get another piece of land and get it, build everything for whatever I want over there. So that is the cost approach. And second one is when the cost approach is mostly used is the terminal one. So when you are trying to reverse it and say, I'm going to sell it, right? Sell it to, for example, for some other purposes, maybe my rationale is that I at least need to get my money back. Okay, so that will be at the beginning and at the end in the two parts. That it will make sense to look at the cost and assume that no informed buyer will pay more for a property than it would cost to build a new one. Okay, so basically this should be the cap of it, or the cost of the building should be really the cap of it. Well, that has some caveat, however, depending on depending on the assumption of unlimited land supply, which sometimes is not available. Okay, so if you want exactly this location, exactly this function, exactly this zoning, maybe you don't get any alternative available. So be very careful about this rationale, because, well, why don't I just go build myself a new one? Well, you may or may not be able to build yourself a new one. Okay, so, and on the other hand, it also assumes that they actually have the time and have the ability to take on and construct a new asset into account. So the relative risk of a ground up development, that's a part of it, because if you want to build anything, there will be a lot of complication coming. And David will be able to tell you a lot about that, because anytime you need to do something that scale, inevitably a lot of things can go awry and things can fall apart. Okay. Yeah, they can often fall apart. These procedures don't work better in a hurry. Yeah, so then things are delayed and making things not work and funding not available. And every part is risky. The cost approach is often used for real estate assets do not have an efficient market for tenants to lease space. Okay, so a common example would be a heavy manufacturing facility. There's not a deep or broad market in automobile manufacturing facilities. So if they go ahead and see a similar facility, they want to use the cost approach, because they want to make sure that they're not paying more than what they would pay if they were constructing a new one. Does that make sense? And say, okay, assuming that the most costly procedure is to go ahead and build my own one, then this one, I need to have a ballpark calculation of how much would that cost me, and then I make sure this one is probably around the same scale, and maybe a little less. Okay, so for the convenience and things, I'll be able to pay a similar price, even if it's a little bit aged. So we also need to compare the investment returns. So the question here is really, does the income producing property provide a competitive return? So of course, all the alternative real estate investments have different natures. So they're not, some alternative investments are not real estate. So the returns on real estates, the risk differences, returns on alternatives is really the kind of risk-free rate and other like market interest rate. It's representing, if you think about it, it's really the opportunity cost, if you will. So basically, if I'm not investing in real estate, how much will my money be worth if I invest in some other area, right? If, for example, investing in stock market and everything else is really profiting right now, is very profitable right now, then I'll be thinking again, or maybe adjusting the cap rate a little higher and think again about the value of the current projects. And on the other hand, if we have, okay, what we observe, for example, in China, is that you really don't have that many of profitable business available. So what's the most profitable business? Well, holding and investing in real estate. And guess what? The real estate market has been gone so high, despite many of the restrictions on the real estate purchase, and you can't actually buy that many of the investment properties and things like that. People still, the real estate prices still go a lot higher, because if you invest in any other part of the business, it's just very hard and less profitable. Okay. we look at in general the risk and return profile of the whole thing, in general, where do the real estate look at? So in general, we're looking at for the least amount of risk, least amount of return, we're looking at T-bill, then of course munis, because munis are partially tax-free, and also backed by the government, of course, not the federal government, but the local government. Mortgage-backed securities, a lot of them is a lower risk compared to the corporate bonds. And then we come right here at real estate. So real estate, traditionally, we say that it's longer term, it doesn't provide as much of return and risk compared to common stocks, but it is still a pretty good alternative. Okay. Then let's go through the types of risk that we have in a real estate. First of all, economic conditions can be a part of it. We can have a different kind of tenants. Okay, so that's especially important for shopping malls, shopping centers, retail parks, and it's also important for office buildings, because if you have very few but very, very profitable tenants, then it's a different story compared to you having many, many smaller tenants, and the whole business risk will be totally different. Okay, so if you have actually very few big, large businesses, they might actually at some time point choose to stop the lease and start their own building. You never know. And once you lose them, the potential risk can be huge. And on the other hand, if you have smaller tenants, that's a different kind of risk. Okay, so you'll be dealing with ongoing recruiting of the tenants and then the turnover and all that. Lease provisions we will be able to provide also sometimes come back to the business risk. Okay, if there's any capital expenditure, you're able to get it back. How much of a term you'll be signing? Is it long term or shorter term? It will affect the business risk. Okay. On top of that, of course, you also have the financial risk. So the financial risk, of course, will increase with the debt. The more debt you have, or the more mortgage you have, you're going to have a higher leverage. And cost and structure of the debt and interest rate or mortgage rate will also affect the financial risk. Okay. And then we have the liquidity risk. Liquidity risk is huge in real estate, because these are typically large properties that are harder to sell, at least a lot less liquid compared to common stocks. So selling properties in Texas, we're talking about what, 6%, right, to the agent in general commission. Right, yeah. So that is a huge transaction fee, and then we also, on top of that, we have inflation risk. Okay, so there might be unexpected inflation coming up. So does the income able to increase enough to offset the inflation? Are you able to somehow increase your rent, your lease, or are they really right? So yes. So John Littler is basically saying that it's a 3-3 split between the agents, so buyer and seller agents, and it's together it's 6%. Okay, so inflation risk is the risk that we typically assume real estate will be able to cover, but in the actual game, are you able to cover will be depending on the competency of the management and your business model, right? So it's part of also coming back to your lease provisions, okay? So you're going to be able to increase the rent as necessary. So that's another question. So one moment, let me jot down notes. Okay, so management risk, competency of management's ability to respond to the market conditions is always the question. And then on top of that, interest rate risk. Okay, so the interest rate risk really involves a lot. It takes a lot in counting towards all those opportunity costs that we've been talking about previously. And say if I have $2 million, instead of investing it as chipping into this apartment or this office building, if I invest in something else, how much will I be able to get? And that will be partially counted towards the interest rate, right? So when the interest rate is higher, even if I'm not taking a really high risk, then I'll be able to get a higher return or higher yield in the bond market, and it's a different story. So typically, the impact on the variable rate debt, first of all, okay, so if you are taking on the debt or the mortgage as a floating rate, remember we have ARM, and that will be kind of coming back into your financial risk and what kind of debt structure you're having. And it could be also impact the high rate in residential property value. Why is that? Why is the interest rate affecting residential property value? Okay, so Jonathan asked a question, say, currently we are looking at buying a property to rent it out and take the lease. Yes, that's because it's the most common form of it. What about a process for the expanding operation of building new facility or compound like FMC or Exxon? If you already have the idea in mind, you, for example, know that what that new facility is for, then it is a different story. It's really not a real estate investment anymore. That makes sense. It's a part of the capital expenditure building facility. It's not really building this thing for investment purpose. On the other hand, if it's building that thing for, even if you're buying a huge amount of property, you're just building a facility. You're putting out a cost for something that you really want to achieve. On the other hand, if you're really doing real estate investment, then coming back to the land and expanding operations, you'll be opening to many kind of similar question. If it's a new building, cost approach most likely, right? So how much will it be cost if you build a new one by yourself, the similar location? Assuming the same for master plan developments. I think the master plan developments are typically, are they done by one single developer? I thought they are usually done by a bunch of people. So yeah, and there's oftentimes, the the zoning code and things coming out first, and then everybody are invited to come in and develop a piece of it. So that would be a very good question actually, when our guest speaker comes, because they have a lot of experience consulting all these huge projects. So, and remember to ask them that question. Okay, so. And you have in general environmental risk. Okay, so so in general, in the United States, environmental risk applies to anyone in the chain of title. If you buy a property with an environmental issue, you're generally taking on that liability, regardless of whether or not you caused the problem. So anybody who actually spilled oil, do anything hazardous onto the property, or put some poison on the ground, and things like that. And if you buy onto that property, then you are liable, even if you are not the one who did it. Okay, so this is what we mean by the environmental risk. And the legislative risk is sometimes the regulation can change. Okay, so the most common most common is, for example, if you have an inspector come in and say, oh, the code has changed and this is not valid anymore, you have to do it, you have to change it. Okay, so which issue? You mean the environmental issues, or everybody in the chain of title? Go all the way back to the history of that piece of land and when that building is starting. So whoever has ever owned it, yeah, the environmental issues. So it will be a complicated thing. Okay, so let's talk just slightly a little bit about the due diligence. So there are 3 primary tools may be employed by investors to minimize their exposure to risk. First of all, try to always avoid the risk and identify the risk through due diligence. So find out through all these parts, okay, is there a potential regulatory change, right? So is there a potential zoning change that forbids you from doing this anymore? What is the interest rate impact looking out there? Then try to avoid any kind of risk possible. That's a low risk strategy, but again, everything comes as a price. If you're not taking the risk, then you're probably paying for reducing the risk. Liquidity risk, of course, partially depending on the market condition, how easily you can sell in the market. Inflation risk, that's a general environmental, general economic and business environment issue. Management risk is the current management competent, doing well, efficient, right? So all these issues, you want to go through them one by one, verify things, especially things like environmental risk, right? So verify in the past, what has it been used for? Has anybody been used for certain kind of hazardous activities and things like that? Okay, so you could, on top of that, after avoid and identification, then try to use, say, insurance, okay, hedging, and sometimes even option contracts to hedge of any of these tools. Okay, so sounds like a discount to many of you, but once the project is big enough, you might be able to buy, for example, insurance on environmental risk, be able to hedge against the interest rate risk, for example. Okay, you'll be able to hedge some kind of liquidity risk and inflation risk a little bit. Okay, and then always diversify. Okay, so quick question for most of you, if you want to diversify, for most of average people coming from like individual, not talking about commercial anymore, for individual investors, if you want to diversify, is it a good idea for you to buy real estate? Okay, so assuming that, right, so these are all assuming and they build something on it, cows and crops, huh? So assuming that most of you are going to buy your own house, right? So if you already bought your own house, and for most of the average household, the house itself is a prominent risk real estate. Does that make sense? And that's already taking on substantial real estate risk. So from that point of view, if you want to diversify, you really want to avoid further exposure on real estate. Instead, look at some other kind of facilities, not facilities, other kind of securities. So that's just my 2 cents. You know, for average American households, most of them are very, very deeply invested in real estate. It's most likely because the real estate can provide the most leverage. So you wind up taking, say, if you're taking, you'll be able to put down, say, 80 grand, you'll be taking the risk of something like what, 320 grand in total, like 400 grand in total. So that's a huge risk. Okay. So on top of that, the last tool we can do is we can also do sensitivity analysis. This thing is also a simple idea, but hard work to really pull off. It's a lot of work if you're really going to execute it. Okay, so the base case scenario, the frame for reference. So basically, you want to provide a frame of reference for the analysis, and then you want to change one single assumption. What is the effect on the NPV, right? So we're gonna change, if for example, one assumption. Suppose there is a legislative risk. Okay, part of the regulation has changed. What will be the result? Okay, so that kind of scenario analysis, and you can potentially, if you are not talking about sensitivity analysis is talking about per individual factors, but if you're talking about for a scenario analysis, then you can change multiple assumptions at once and identify most likely ones, the optimistic ones, the pessimistic ones. You know, you can do as many possibilities as you want. So that, again, I say this is a homework that it's more an art than a science. Then and you gotta know when to stop that. Okay, so let's take another break of 10 minutes and we'll come back. And now, if we don't have any question about commercial part, we are moving on to the next part. We're going to talk about the structured real estate investments, and we'll start talking about some forms and a joint venture. When is the due date for homework assignment 2? Let me see. The due date for homework assignment 2 is April 22nd. So you have 3 weeks from now. Okay. Okay, take a break and let's come back a little bit later.